In Spiceline Chapter 5, we will study accounts receivable. We'll begin with Part A and credit sales transactions. Let's quickly review. Let's assume that on March 22nd, we prepare and deliver a tax return to a client. We invoice the client $500 and request payment within 30 days. We receive payment on April 21st. What journal entry is required on March 22nd? We debit accounts receivable for the $500 we expect to collect in the future, and we credit services revenue for the $500 we have earned. On April 21st, when we receive payment, we will debit cash and credit the account receivable. In Chapter 5, we're introduced to the concept of discounts. The distinction between a trade discount and sales discount centers around the date of sale. In the case of a trade discount, we're talking about before the fact, at the time of sale. In the case of a sales discount, we're referring to something after the fact. It may or may not happen. First, trade discounts. A trade discount is a reduction in the listed price of a product or service at the time of sale. You're accustomed to this. It's simply the sale price that the merchant is advertising. We will record the sale at the discounted price because it is the actual agreed to sale price. There is no uncertainty about it. Let's go back to our example with the CPAs. Suppose, as an incentive, we offer our customers a 10% discount to get their information in by March 31st. With the trade discount, what journal entry will we record? First, we have to calculate what the actual price is. We're offering a 10% discount on the $500 full price amount, so we are in effect offering a $50 discount. The new agreed upon discounted price is $450. The $500 full price minus the $50 discount. The journal entry will be the agreed upon sale price of $450. Next, let's discuss sales discounts. A sale discount is an event that may arise after the date of the sale. Notice may arise. It may not arise. It is an event that lies in the customer's hand. It is one of three types of contra revenues we will study. Other examples are sales returns and sales allowances. We use the term contra, recall, to mean opposite the normal account balance. So a contra revenue will have a normal debit balance. A contra revenue reduces the amount of revenue reported on the income statement. The first type of contra revenue we will study is the sale discount. A sale discount is a reduction in the amount that the customer will pay if payment is made within a specified time. The intention here is to encourage customers to pay quickly. On an invoice that is given to a customer, we communicate the sale discount in shorthand terms, such as 210 net 30. The 2 represents the percentage discount that we are offering the customer. The 10 represents the number of days that the customer has to make payment. Following the comma, the N is net, which really stands for the full price if payment is not made within the number of days specified. So the 210 net 30 will communicate a 2% discount if payment is made within 10 days of the date of the sale. If not, we're expecting full payment and we're requesting that to be made within 30 days. For example, on November 10th, assume Muskie Company provides services on account to Flyer Company for $20,000. Terms are 310 net 30. The journal entry on November 10th will be to debit accounts receivable in the amount of $20,000, the full price. We credit service revenue. If on November 19th, which is within the 10-day discount period, the customer makes payment, how much cash will we actually receive? $20,000 multiplied by 3% discount is $600. Muskie will receive only $19,400 for the $20,000 of services that were provided. The $600 represents a sale discount, an incentive for the customer to pay quickly. So, what journal entries are required? We will debit cash for the $19,400 payment received. We will need to credit accounts receivable for the full $20,000. The customer has satisfied its full obligation with the $19,400 payment. The customer does not owe us anything anymore, so we have to reduce the T account balance by the full $20,000 that was previously recorded. We know debits must equal credits, so we need another $600 debit, and that is our contra account. That is our sales discount. Observe, after making payment of $19,400 in cash, the customer owes us nothing now, so we must reduce the account receivable balance to zero, and thus the credit to account receivable for the full $20,000 that was recorded at the time of sale. Using the sales discount account allows us to show both the $20,000 sale and the subsequent $600 discount on the income statement. Here would be the presentation. We record the actual sale price, the transaction that was agreed to, and then the discount that arises after the fact. There was no certainty that the customer would take advantage of that. We did not know that at the date of the sale. Recording both items nets to the amount of cash that we actually received. Let's continue the example and assume that the customer does not pay within the 10-day discount period. Muskie would receive the full $20,000 of cash. The required journal entry would be a debit to cash for the $20,000 received and a credit to account receivable for $20,000. Notice there is no sale discount. Other types of contra revenue include sales returns and allowances. A sale return arises when a customer returns a product. You're accustomed to doing this in the case of buying a product, taking it home and finding it's the wrong size or the wrong color, or returning it for a variety of other reasons. A sales allowance arises when a customer's balance owed is reduced because of some deficiency in the company's product or service. In the case of a sale return, we will record the contra revenue account, sales returns with a debit, and we will credit accounts receivable if it was a sale made on account. If it was a sale that had been made for cash, the credit would be to cash. But in either case, our debit is to the contra account sales returns. In the case of a sales allowance, similarly, we have a debit to our contra revenue and a credit to either accounts receivable if the sale was on account, or a credit to cash if the sale was for cash. Let's examine an example. Pavers Inc. provides paving services to a customer on account for $8,000. On May 5th, before collecting the receivable, the customer complains about cracking in the pavement, and Pavers Inc. agrees to offer a 20% allowance. What price concession is Paver granting? $8,000 multiplied by the 20% allowance, $1,600 price concession. The journal entries that are required: at the time of the service, we would record an account receivable, the $8,000, and credit service revenue for $8,000. When we agree to the 20% price reduction, Pavers Inc. must record contra revenue in the form of sales allowance and reduce the account receivable balance by the $1,600 price concession. Notice we've used sales discounts, sales returns, and allowances to report reductions in our net sales revenue. Why bother with contra accounts? Why not just reduce sales revenue itself? The answer is that it provides additional information. Consider, there's a significant difference between the economic activity of a company that makes $800,000 in sales and has zero merchandise returned by its customers, as compared to a company that makes $895,000 in gross sales but has $95,000 merchandise returned. Each nets $800,000 in sales, but maybe one sells defective products and the other does not. One will incur administrative costs necessary to process the sales returns. Others will not have that cost. And there could be other differences. This information could be very useful and informative for financial statement users. Ask yourself the question: if you're a potential investor, in which company would you prefer to invest? Which one sells the higher quality product most likely? In contrast, maybe you're not an investor, but you're thinking about locating a new coffee shop next to one of these merchandisers. Which one will offer greater foot traffic in and out of the store? In the latter case, the company with $895,000 in gross sales and merchandise returns probably has more foot traffic, customers coming in and out of the store, and represents the better location for a coffee shop. On the other hand, if we're looking for the company that sells the highest quality merchandise, and perhaps will have greater customer loyalty and offers a more attractive investment as an equity stock investor, we might prefer the company with only 800 in sales because it has zero merchandise returns. The nature of our decision affects what information we want, but the point is, by reporting the contra account, we are able to provide additional information to the financial statement user.